All right, welcome back. Today we're going to dive into the foundation of price action, which is what? Market structure. Now, trend structure can be broken down into two main phases, swing structure and a substructure. And if you can understand how to differentiate between the swing structure from the substructure, you can have a really nice trade and a better understanding of the market overall. So what then is the difference between the swing structure and the substructure, and how can we then use it to our advantage in the market? All right, before you hear is a trending market. And why do I call it a trending market? Because this market is basically what? Or creating higher highs. Sorry, it's basically creating what? Higher highs and what? Higher lows, and higher highs and what? Higher lows. And it is trending to the upside. Right. This is what I like to call a swing structure, and it comprises of what? An impulsive and an impulsive phase and a corrective phase. This also is an impulsive phase, and this is what? A corrective phase or a pullback, either impulsive, corrective, push or pullback. But the difference between the impulsive and the corrective phase, if you notice, this leg is longer than what? This leg, and this leg is longer than what? This leg. That's why we call it the push phase or the impulsive phase, and the what? The corrective phase. Now we have the push or the impulsive phase here. We will be expecting what? The corrective phase. This is what I call a swing structure. And swing structure can be what? Any time frame, depending on what? Your what? Trading style and preference. Take, for example, a daily time frame. This could be what? The daily time frame or the 24-hourly time frame. So within this daily leg, if we zoom in on the lower time frame, is a collection of structures, of smaller structures on the lower time frame. And that will look like something like this. That will look like something like this. So within this impulsive leg is a collection of structures on the lower time frame, and within this corrective leg is also a collection of what? Structures on the lower time frame. So how then do we use these substructures to our advantage in the market? We want to be able to trade into this larger leg. That's the leg of the swing structure. We want to be able to trade this substructure within this larger leg of what? Of the swing structure. And whenever the market is retracing or pulling back, we want to trade what? The pullback of this what? This swing structure and a what? A substructure. How do we do that? By simply recognizing the turning point, or when the trend of the lower structure actually change. So if we change from trending up to trending down, we take what? This corrective move, and the market change character from trending down to trending up, we take what? This what? Impulsive leg move. So we're going to go to the charts and identify these, or differentiate between this swing structure and the structure and the substructure, and how we can use it in the market to what? Our advantage. So let's get right into it. All right. Before you hear is a daily time frame of the volatility 25 index. And we have a trending market in this case, that is an uptrend in this case. And you can see that the market is pretty trending up. An impulsive leg, a corrective leg, impulsive leg, a corrective leg. We have an impulsive leg, a corrective leg, impulsive leg, a corrective leg, impulsive leg, a corrective leg, impulsive leg, corrective leg, impulsive leg, and what? This is where the current price action is. Now, within this swing structure, being the daily time frame, if we zoom in down to observe what happened between this corrective leg, you will realize that it is also a smaller trend on the lower time frame. This corrective leg on the lower time frame, let's map them out and see how they look like. This corrective leg on the what? Lower time frame. Corrective leg on the what? Lower time frame. If you zoom out, if you zoom in to the lower time frame, take for example the 1 hourly or the 15-minute time frame, you will realize that within this impulsive leg is a trend, and within this corrective leg is also a trend. Within this impulsive leg is a trend, within this corrective leg is a trend, right? So That's when we buy one simple concept, all right? Let's zoom it down to 15-minute example, for example, 15-minute time frame, and see how this impulsive and corrective leg develop on that lower time frame, which in this case is our what? Substructure. You can see that on the 15 minutes, what looks like 2, 3, 4 candles on the daily time frame, which is our swing structure, coming down or zooming in into it on the 15-minute time frame, you can see that it is what? A trend on its own. You can see that this market is pretty trending down, and basically here is also a trend up, here is a trend down, here is a trend up, here is a trend down, here is a trend down, here's a trend up, here's a trend down, here is a what? A trend up. So within this impulsive and corrective leg of the swing structure, it is a trend on the lower time frame. If you look at the daily time frame, this is just more or less like 2, 3, 4, 5 candles. But here on the 15-minute time frame, it is a trend on its own. Let's use this particular point as an example. You can see that this market is what? Creating a what? A higher, a high, a lower low, a lower high, a lower low, right? A lower high, lower low, lower high, lower low, lower high, lower low, lower high, lower low, and all that. You can see that in all of these, right, it is a trend, both the corrective and the impulsive and the corrective leg of the swing structure is a trend on the what? Substructure, which is, I call it the smaller trend on the lower time frame. How then do we use this lower time frame substructure or the substructure to our advantage, or to trade with it when we want to place a trade in the market? Now, that's when the concept of what? Change of character comes into play. If you observe well, when the market is trending up, it's going in this format, right? If we have a break of this low here, that's this particular low here, we call it what? That's when we call it a change of character. That means the market has stopped from trending up, possibly trending down from this particular zone. And what we should be expecting is this market to pull back and start creating what? A downward trend. That is where the idea is. So when we have an impulsive leg on the swing structure, what we want to see on the substructure is a change of trend or a change of character. If you look at this change of character tells us that the impulsive leg on the swing structure is about to kickstart. Let's observe what happened here. This particular market was trending down on this particular time frame. But when we get down to this particular region here, that's the whole of this region, something happened. There is a change of trend on this substructure time frame. That is the 15 minutes to be precise. There's a change of trend here. And where did the change of trend occur? It happened exactly here. So when we have this change of trend, what we should be expecting is what? The market should start trending up from here. So when we have a change of trend, we begin to look for or to dive into some of the key concepts we used to tell on where to enter the market from. We use engulfing candle. We use some of these supplies and demand. We have imbalance here. We have imbalance here. These are potential entry points. Okay, so when we have this change of character exactly at this level, what we need to look for is either a demand zone, an imbalance, engulfing candle, or whatsoever entry criteria you use to enter the market. But the basic concept is we want to navigate through the substructure into the swing structure. Once we understand that this market is pulling back or exhausting or correcting back, and we're expecting this next impulsive leg or the longer leg of this higher time frame, that's the daily time frame in this case, what we want to see is a change of character or a change of trend on what? On the lower time frame. If you observe, before this market starts trending up exactly from this point, there is a change of trend exactly here. And also, before it will start correcting, there will be a change of trend also, because this market was trending up. From this point, it started what? Trending down. So we need this change of character to be able to tell us that the next impulsive leg on the higher time frame is about to kickstart. So when you have that, that's when you begin to look for your entry criteria, whether you're using order block, imbalance, or whatsoever thing as your entry criteria before you start getting involved. So the moment the price action change exactly at the particular level, then we begin to look where's the potential point to look for entry. Look at it here. We have imbalance here, which is a potential entry point. Or you wait for what? An engulfing candle, which is standing here, which is a more precise way of entry. An engulfing candle, and you what? Go in for the long, targeting the what? The next, because the market is trending up, you target the next impulsive leg that is about to kickstart. So we navigate from the higher time frame down to the lower time frame, then from the lower time frame, targeting the next impulsive leg on the higher time frame. So the swing structure being the higher time frame creates within those legs, there are substructure on the what? Lower time frame. And we take advantage of them by understanding when they are trending down or when they are trending up. For a daily time frame to start trending, for 15-minute time frame or the substructure to start trending down, there must be a change of character. What we call the change of character is market to change from what? Trending up, in this case, trending up, down, now into trending down. So as the market change from trending up into trending down, that is what we call, exactly this point is what we refer to as what? Change of character. So the swing structure, that's the higher time frame, within those impulsive or corrective leg, creates another smaller substructure on the lower time frame. And we want to be able to read them correctly to be able to know when they are trending up and when they are trending down. So your key advantage is being able to recognize that this market is actually trending up and this is actually trending down, and you're good to go. So this is the difference between a swing structure and a substructure. This is how you differentiate between swing structure and substructure. Please, the substructure, understanding of the substructure should be able to tell you the current trend or the current phase of the swing structure you are trading at that very moment. Right? So if you find this content useful, please click the like button, subscribe, and until next time, peace out.